Hello, welcome back. Thank God it's Friday, right? Hope you're gonna be having an awesome weekend. I have some exciting news. This tool is getting released come Monday. I will let you know about the details. It's going to be open for Patreons, and I'm gonna be making a dedicated video, tell you how to access and everything, give you all the information, and a little bit of a tour around the tool. Although I'm pretty sure a lot of you already know how it works. But let's take a look at Shopify in this video. It's a company that has been doing badly lately. It has lost a lot of its value. And look at this. Its 1 year high has been $1,700 and it has lost 72% of that, 73 almost. And Shopify used to be overvalued for sure, but as the company drops its price, there may be a point where it becomes an interesting purchase. And this is what we're going to be examining right now, especially since it had a massive drop. It used to be 600 or so here just a few days ago. So it may be a very interesting purchase right now. Let's take a little bit of a closer look at the financials of the company and decide whether that's the case or not here. Now, if we take a look at the P ratio, you will notice that it's sitting at 21 and it has been much higher and also negative as well. So things are getting better in terms of the P ratio as you are seeing here. We want it to be in the low teens if possible, but 21 is very fair. The price to free cash flow ratio does seem elevated still. Of course, we're gonna look at the details a little bit later, but much better again than what it used to be. And the outstanding shares count here has been dropping has been increased 19% higher than what it used to be. Look at this, it used to be about 96 million and right now it's sitting at 114. So the company has diluted investors taking advantage of the stock price. Now they seem to be buying back some shares, as you're seeing here lately, the last year pretty much. The key metrics in terms of growth are amazing, and that's one of the key things about Shopify. The company is growing like crazy, and myself, I really like Shopify as a company. I think it's a company that has tons of future, but I want to make sure that if I'm purchasing it at a cheap price. I never buy things expensive because it really matters to buy cheap things when you are investing. You don't want to be buying things when they are very high or very expensive. That's a very bad idea for a long-term investor. Okay, so let's see the other metrics here. The careful observant may have seen something that's a little bit out of the ordinary here. The gross profit margin is actually less than the net income margin. And that's a little bit abnormal, isn't it? It almost looks like a mistake. It's not a mistake, this is actually the case. And it's infrequent, it doesn't happen often. It can happen because the company is disposing of some assets and so they're gaining indirect profits because of this, or just because they are having operations that are outside their core business, so they're making significant income that's not really related to their cost of goods. Because remember, gross profit margin is about revenue minus cost of goods here, and the net income margin does include other indirect resources as well. So this is why it's elevated here. This is probably a one-time thing. You would normally be expecting it to be less. I'm thinking that potentially it must be at around these levels here and not over here, because there must have been the odd one out because of probably they disposed of something here. But yeah, it's worth noting when you see something like this, you can immediately think of something of that sort happening with the company. And of course, you can investigate a little bit further if you want to. But the return on equity here is pretty great, but the invested capital return not that great, however. But the debt to equity ratio is very low, so the company doesn't have a lot of debt compared to equity, and the current ratio is also pretty great. So they look fine in terms of debt here. But let's take a look at the actual financial statements and see exactly what is going on with the company. See the numbers a little bit and some stuff in detail. From 600 million to 4.6 is the revenue growth. Pretty great. And see here, the company used to have negative net income and now they're growing to positive values. And this is much more positive than you would expect. And you'll see the discrepancy here. And this is what increases the margins here tremendously. Again, I'm pretty sure they sold something. It looks like that's the case. We can definitely take a little bit of a closer look, but just by using the tool, you can kind of already deduce this information just by looking at the numbers, really. So the balance sheet here, you will see that the assets of the company here, the total assets, have been increasing pretty nicely. Quite a lot, actually, from 1 billion to 13 in 5 years. That's in tremendous growth, of course. And the total equity here from 1 billion to 11 billion, again, insane increase, Insane, just insane, absolute insane increase in total equity of the company. Doing very well. Okay, what about the cash flow statement? So the cash flow statement here, you will see that the net cash provided by operating activities has been increasing as well. And the company is having a little bit of depreciation, amortization, and stock-based compensation. It's not that much, but yeah, the net cash provided by operating activities has definitely increased. The cash used for investing activities here is in the negative, which is a good thing to see. They're purchasing investments like crazy here. Kind of like that from companies. They don't have many capital expenditures. It's software for the most part. That's another great thing about a company of this sort. And they are sitting in a much bigger pile of cash than what they used to sit on. That's another good thing to see here. And the free cash flow here has been increasing as well. So the company seems to be doing, generally speaking, pretty well. But what's well, we need to quantify, and we need to see whether it's worthwhile purchasing right now. Again, we're gonna be based on what the company is doing financially and not just out of our hands. That's not how it works. So the revenue growth for the company has been staggering, of course. This is not something that we can use, but this kind of average, 65-64%, definitely not. But we can still go a little bit high. I think I'm going to go 20, 22, and 24. I think the company can achieve that for sure for the next 5 years. The net income margins are, as you see here, for the most part, I'm going to be using the values that are, that have happened in the last couple of years. I'm going to go maybe in between 40, 50, and 60, because it is getting better. The free cash flow margins here, 40, 49. There's some discrepancies here, of course. But yeah, this is a little bit all over the place. It's a little bit tough to deduce. But I'm going to go 50, 60, and 70 here. And of course, when you get your hands on the tool, you can try your own estimates and see how you want to quantify that. Okay? And 13% is what I'm going to be making out of my single stock investments, because I can make 10% out of an S&P 500 ETF. I have more risk here. I need to be making more money. And so when I hit calculate, we are getting that it's getting closer, especially for the low and medium tiers, or especially for the medium tier, I'd say. It is getting closer, and I never expected that from Shopify, to tell you the truth, because I always thought it was massively overvalued. But it comes a point where everything goes down, right? Everything that's overvalued at some point, maybe it becomes less overvalued at some other point. And that's the case with Shopify. It starts becoming a little bit of an interesting proposition here. Now, for me, I do want to be buying things when they are dirt cheap, if possible. So I think that I would probably add Shopify to my portfolio. If it would reach around 300, I want it to be at around near this low and medium level at least. And these projections are not conservative either. I mean, you could even go a little bit more conservative and get even lower estimates here, but I think they are fair, to tell you the truth. And so if I would get something like $250, $300, that would be pretty amazing. And so this is where I would suggest buying the company. At least for me, that's what I would do. So I hope you enjoyed the video. I hope you found some good value out of it. Let me know what you are doing with Shopify. It seems like it's getting better and better in terms of a potential investment. And I hope you enjoyed the video. Please leave a like and subscribe if you did. Remember to subscribe, because as I mentioned, Monday I will let you know how to access this, and it's gonna be awesome. So you may want to be around. Thank you for watching the video, and I'll see you around. I'll see you soon with the next one. Bye bye.